I think, as you mentioned, he'll downplay the possibility of negative interest rates, while at the same time making it clear that the Fed will do what's necessary to make sure that liquidity conditions remain stable in the market. The Fed has been very successful at that through opening up new credit facilities, quantitative easing. But given the experience in Europe, the downside of negative interest rates, the unintended consequences, we think he'll stay with the line that the Fed is against moving to negative short-term interest rates.
Right. I want to bring across the spread between the 2-year and the 10-year for you, because it seems like there's a lot of interest coming in to the shorter duration bonds versus the 10-year and the longer duration securities. Do you think that's also part of the risk aversion that you're seeing, largely bond investors getting wary of parking money for the long term?
Yeah, I think that investors are moving further out along the curve. They realize that yields in all likelihood won't be going up anytime soon in that portion of the curve. In fact, given the outlook for inflation or the lack of it, the fact that we've had back-to-back declines in the CPI, a very real possibility of deflation in the U.S. for a period of time, those bond yields could come down a bit. And that is a risk for the Fed, that if market-driven rates do continue to move lower in response to lower inflation rates, strong demand for Treasury securities, that leaves that front end of the curve vulnerable. But again, we just don't see the Fed moving those rates below zero at the very short end of the market.